Investor, someone who utilizes money and expects a financial return in the future. In our story, you are the investor. When investing, you first define your reason for investing. How much do you want to earn? The problem is, you can also lose money. So next, you decide your risk tolerance. Risk tolerance. Risk tolerance is the potential financial loss that an investor is willing and able to accept. Suppose you invest $100 and have a 40% risk tolerance. You'd be okay if your investment goes down to $60. Risk tolerance depends on your personality, needs, amount, and investment timeline. Based on your risk tolerance, you form your portfolio. A portfolio is a collection of assets. But what are assets? Assets are resources that can provide financial returns in the future. Let's compare it to the definition of investor. Oh, now we see. You, as an investor, want financial returns, and an asset provides you with those financial returns. So, a portfolio is just a collection of these different assets. Now, you might be wondering, what exactly are these different types of assets? Also, why do we need a collection of them and not a single one? First, let us look at some different types of financial assets. 1. Stocks represent ownership in a company. You literally own a share of the company. 2. Bonds. Buy bonds to get regular interest payments and also your original amount after a certain time. 3. Commodities. Physical goods like gold, oil, or agricultural products. But instead of carrying real products, you buy financial contracts that expose you to their prices and thus profits. 4. Foreign exchange. Profit from fluctuations in exchange rates between different currencies. 5. Real estate investment trusts, REITs. Here, you don't own physical land. You invest in companies that own lands and take a share in their profits. 6. Derivatives. You sort of make a bet on what the future price of an asset, like stocks, bonds, or commodities, will be. Basically, these are contracts whose value is based on underlying assets. 7. Cryptocurrencies, digital coins that utilize blockchain technologies. They are protected by cryptography and cannot be counterfeited or double spent. 8. ETFs, a diversified portfolio of stocks, bonds, or other assets that you can buy just like stocks. ETFs are portfolios in themselves. You can just readily buy them. Now, let's take a quick look at the other side of portfolio. Why do we even create a portfolio? Why don't we just invest in one of the assets to make our life easier? Because of risk. Risk means the chance of losing your invested capital. Let's look at market risk. Market risk is one of many kinds of risks. It is the risk of investment losses due to factors that affect the entire financial market. For example, interest rate fluctuation, inflation increase, etc. But it can be managed with diversification across assets. Question: how does diversification reduce market risk? Let us first look at what happens if we don't diversify. I'll pick one of the financial assets, bonds. You invest your entire investment of $100 in bonds. Then comes market risk. Inflation rates increase from 2% to 9%. Quick note: inflation is the rate at which the general prices rise in a country. This means people will change their spending habits. Some assets will gain value while some will lose value. Bonds' value will decrease. You had invested all your money into bonds. Your $100 decreased in value to $70. Now, what if you had diversified? Invested your $100 in bonds as well as stocks, commodities, and REITs. With an increase in inflation, bonds' value will decrease. Stocks' value will increase. Commodities will increase. REITs will also increase. Overall, you secured profit because of diversification. Diversification, when implemented, is called a portfolio. That answers our initial question. Why do we even create a portfolio? The easiest way to diversify is to invest in ETFs. In the next chapters, we'll look at stocks and all of its related terminologies.